One, it makes you more money when you decide to sell the company. You get a higher purchase price from doing it. And number two, it saves you from losing money after the sale is complete by having good, strong contracts.
If you hire a banker transactionally, it's going to be a transactional experience. It's the same with attorneys. I mean, so like the risk was super low, but all the buyer saw was this, hey, some of your IP is owned by somebody else. How do we know that this isn't going to be a problem? And you don't, and everything you did wasn't developed off of this. And so, these are things like you want to be super careful about early, because you might not think it's a big deal.
One reason why it's very important that your banker and your lawyer are on the same page. I want entrepreneurs to really listen to this. At Navidar, over our 15-year history, 90% of available earnout dollars have been paid to our clients and in our clients' pocket.
The question is, what is a liability and what is indebtedness? And that's where we see the most negotiation on as it relates to the definition of working capital.
Thanks for negotiating a great deal for me.
Disclaimer, the views are the guests alone, not those of the host or sponsors.
Welcome to a new episode of From Boots to Boardroom. I'm your host, Hari Vasudevan, founder and CEO of Cairo AI. Previously, I was the founder and CEO of Think Power Solutions. The show shares the educational, entertaining, and entrepreneurial journeys of those who power America. Presenting sponsor for the show is Cairo AI. Digitize work and maximize profits. For more information, visit cairo.ai. Today, we have two special guests. First show we're doing with two guests, Scott Craig and Stephen Day. Scott is a partner with Latham Watkins, the second highest grossing law firm in the world. For more information, visit lw.com. Stephen Day is the co-founder and managing director of Navidar, investment banking firm and trusted advisor for M&A and capital raise. For more information, visit navidar.com. Thank you so much, guys. I appreciate both of you being on the show.
Happy to be
Thank
here.
you, Ari.
Awesome. So let's get started here. This show is truly for entrepreneurs at the end of the day, right? I mean, we all build businesses, we start businesses without really knowing what we're doing. I mean, I can tell you that is my personal experience, right? And then you get to a point where you need to raise capital or go towards an exit, and then you realize you've not really done many things right? So for Stephen Day, let's get started here with you. When you first encountered the big hiccup in my deal, that both of you guys, super fortunate to have you on my deal, where there's $5 million missing in EBITDA, right? What were you thinking? And then I'll get to the next question, which will help entrepreneurs out. So what were you thinking? What are your thoughts out there?
Well, when we come across a difficult accounting situation like that, you start pulling on the string of a sweater, and what you're afraid is the entire sweater will come apart. And so that's our number one concern, is when you have something like that that's unknown discrepancy, is with the accounting background, the audit background, is your first question is was there fraud? Did somebody take, $5 million from your account and try to cover it up? So of course, fraud is very difficult to detect, and it's obviously it's a very scary thing if that's the thread that you pull on. Luckily, that was not your situation. It was just, you had a poor accounting leader in the seat who had poor accounting processes and controls, and we were able to get to the bottom of that, relatively quickly. But those are the things that come to mind as a trained auditor.
Yeah, no, it's good. But that is a great learning experience. And the reason I'm starting out with this question, first of all, that gave rise to Cairo. That's what we're doing right now, right? But more important question is, why should an entrepreneur engage with a banker and a law firm early in the entrepreneurial journey, right? Because I remember Scott asking a question, hey, who set up your company, right? Because it's hairy. I set it up, right? No law firm for 7-8 years, right? So things I learned definitely incorporated in the Kairos journey, if you will. So maybe we'll go to Scott here on this question. Why should an entrepreneur engage with a law firm and a banker early on? What are the advantages that they get?
Yeah, I mean, I think with respect to the law firm, it depends a little bit on what kind of company you are, on what kind of law firm you should engage. But if you're going to hire employees, if you're going to raise capital, if you're going to if you're technology heavy, if you're SaaS software, there are things that just you need legal help for, and the earlier you do it, the better, because what you don't want to do, and I'll give a couple examples. You don't want to hire a bunch of contractors and keep them on as 1099 and call them contractors, but they're really working for you full time, and they should have been employees the whole time. If you brought attorneys in, they could have helped you manage that, either to do the right things to make sure they're actually contractors, or to, hey, no, these are employees, let's convert them so you don't have a classification issue. Another one would be, if you're a SaaS software company, your terms of service and your privacy policy are really important. And I don't know how many times I've had clients that say, yeah, we just pulled it from either a competitor or a public company that was what we aspire to be, and we copied and pasted and we changed some words and we posted on our website, and that's enough. And it's not. I mean, I think, we talk to our technology attorneys. Terms of services can be a little templated, and you can work from that. Privacy policies are bespoke, and for, even if two companies are very much alike, there's enough differences that you need to talk to an attorney about how to put that out there. So those are just a couple examples. I mean, there's lots of others around raising capital, around employee equity, and again, I think a lot of companies can be a little penny wise pound foolish in all areas of services, lawyers, accounting, because there's not a lot of cash early on, and you don't want to spend it. But I think the best service providers will work with you on how to make sure that the company's got enough cash to operate, but also make sure that they're getting paid for the services they're providing at the right times.
Yeah, no, fair point on that. All those issues that you pointed out, I actually went through all those issues, right? And those are all the things that I'm trying to avoid at Cairo. Hopefully, some of the entrepreneurs that may listen to the show can learn from that. Stephen, what's your take on that?
Yeah, I think it comes down to two things. One, it makes you more money when you decide to sell the company. You get a higher purchase price from doing it. And number two, it saves you from losing money after the sale is complete, by having good, strong contracts. And so, a purchase price can be impacted by, poor customer contracting. Purchase price can be impacted by, poor accounting, information. And likewise, after the deal closes, there might be an escrow, or there might be other terms and conditions that you have to satisfy. And if you don't have a well-worded contract, you could end up giving money back after the close of the transaction. So I think there's a very direct correlation to, you get more money in a sale and you reduce the risk of losing money after it's closed.
Yeah. When you believe in yourself and you believe in the company that you're building, it's better to build it right? So I took the advice of both of you. And actually, the second company I'm running, obviously, from day zero, audited financials, GAAP financials, right? So no such issues on the back end. So, let's kind of back up a little bit, right? We talked about some of the issues, but let's kind of get to your experiences that shaped your leadership style, both personally and professionally. And the reason I'm bringing it up is having worked super closely with both of you. It's very unique. I've spoken to a lot of my friends who started companies, sold companies. They're actually genuinely surprised that I'm friends with my lawyer and investment banker, right? Stephen, you come to my house with your family. We've had a meal together. We catch up all the time, right? Scott, you've helped me through so many situations since the deal, right? So I really want the audience to know, what is it that, from your personal and professional experience, that makes you who you are, the leadership style that you bring in, so that they can understand you a little bit more. Maybe Stephen, you can go first.
Sure. Well, I appreciate that, Ari. And I would say, in terms of from the leadership style, boy, it's hard to pinpoint, where all of that sort of came together. But I will say this in terms of being able to maintain friendships with our clients, I do think that's a bit unique, for the industry, because these transactions are very difficult. They're very stressful. There's, very tough moments in them. But I think that, I had a banking mentor when I first started investment banking some 25 years ago. And, um, his name was Gordon, and he said, Stephen, every day when you take that elevator down to the first floor, make sure you take your integrity with you. And that really stuck with me. And I think that one of the reasons why, Navidar, Tim and I have been able to maintain good relationships and have a lot of repeat business is because we don't overpromise, we don't mislead, we work extremely hard, we try to be very creative in what we do, and we try to deliver the very best investment banking service that we physically are able to deliver. And I think when you focus on making sure that every day when you take that elevator to the first floor, you keep your integrity intact. I think it's sometimes as simple as that, of just making sure that everything that you say and do during your engagements is something that you don't have to worry about. There's another lesson that Goldman Sachs taught me, is to make sure that whatever we do on a transaction, if it shows up on the first page of the Wall Street Journal, that it's an article that we're proud of and not one that we're embarrassed by. And I think that's another very simple rule. If what you're doing was reported on the first page of the Wall Street Journal, would you be proud of that or would you not? And so I think some simple life lessons like that have been good guiding posts for us.
Yeah, no, awesome. Scott?
Yeah, I mean, first, just to have worked with Steven and Navidar on a number of deals, and what I've always found great about Navidar is, in that middle market M&A world, a lot of investment banks, they come in, they help you get the PPM out or the SIM out, and to market your company, and then they help you navigate the negotiation with the various interested parties. But once you're on exclusivity, it's like they're working against you a little bit because they see that fee, and I've run into situations in the past where I almost feel like, wait, who's your client here? We need to protect this company, and if that means that we don't close as quickly to get the terms we want, that's what it means. But when we're working with Navidar, I've always felt that throughout the whole process, just like me, that they are advocating for their client to the very end, and even if that means delaying, or if it's not good for their client to close that deal, giving that advice, that they do that, and I don't see that, and that's my job too. But I've always felt collaborative with Navidar because of that, and I think that that's an important piece. I just wanted to say that. And from my perspective, sort of a different path. I was a biomedical engineering major in undergrad, and I hated it. I was really bad in the laboratory, and so I took a consulting job like everyone did back then, and for a software company. And I loved the client service aspect of it. I was out there helping install software in warehouses and meeting different types of people, and sort of the tip of the sword. But I didn't sell the software, and I didn't develop the software. And so salespeople would overpromise, developers would underdeliver, and I had no control over that. And I remember talking to my dad and said, like, I love this client stuff, but I hate being out of control. And he's like, well, go to law school. And that's sort of how it's turned out. Like as I've grown as a lawyer, I've been able to kind of help manage the whole process and stay involved, both sell and deliver, and be the tip of the sphere from a client-facing perspective. And I think one of the things that I've learned that clients really appreciate, and obviously substance and getting things right and getting the best deal possible is the most important thing. But I always say, like, that's 1A. 1B is responsiveness.
Yeah.
And I feel like if as lawyers, we have to make sure that, especially if there's a really big deal going on, that our client knows we're on the ball and ready to act and available. Even if that means I'm hopping on a plane, I won't get back to you for 3 hours. The fact that there's been that touchback helps the client have comfort that, well, they saw the email and they're going to take care of it or get somebody to take care of it. I think in our space, as people get busy, emails tend to float to the bottom of the stack, and that can create anxiety both for the client and for me sometimes when I'm like, wait, why hasn't someone responded to this yet? And I think just the responsiveness and keeping the relationship warm throughout the process is really important so that people know that they're being, taken care of.
Yeah,
All
no,
right,
it's
I'll tell you one quick story about
yeah,
Scott.
yeah.
I think it's my very first deal with Scott when I fell in love with this guy, and we were I called him up spontaneously. It wasn't a scheduled call. It was in the middle of a deal. It was regarding a deal. And he was right in the middle of a move. I mean, literally his entire house, I think, was in boxes in the house, and the movers were there picking up boxes. He's like, "Hey, can you give me a moment to, set up my computer and open it up, and I'll take a look at it." And so he had to go find a box to set his computer on, open it up, turn it on, look at the document, look at the issue, and gave me an immediate response to what we needed on this deal to unlock whatever issue it was and to keep moving forward. And I'm talking about that's the kind of guy I love. That's responsiveness to the
Yeah,
to the industry.
he's the guy you can work with,
Yeah.
right? It's interesting. I was about to say something similar. When our deal was going on, the ThinkPower Solutions deal was going on. Towards the end of the deal, if I remember right, Scott's wife was sick. She had COVID or something like that, and he was nursing her, but he was just responding. I can't believe how he did it, honestly, right? I really can't believe how he did it because he was managing so many different things. Kids were sick, something like that, and things were actually flowing really well. I mean, I'm wired that way. I remember once I was in India traveling, 1 a.m., a customer calls me and I answer the phone. They didn't even know I was in India. And I come back and I tell them, hey, I was in India when you answered. And when you called rather, and they were actually really surprised by that. So I'm wired that way. I deeply
Yeah.
appreciate how Scott works.
Yeah, and I think you can balance it, right? People for the most part are understanding. So if you are going through something or have some other things that are distracting you, even if it's other transactions, you can set expectations. I think as long as you set expectations correctly and meet them, and that's the most important thing. But like the worst thing is just people hanging and waiting and waiting. And I think that's what, especially when you're in the middle of the deal, is hard because hard for folks like you. I mean, this is like life changing, and you want to know that the people that are helping you are totally involved and bought in.
Yeah, no, 100%. I agree with you on that. So that's great. Maybe we'll kind of get a little bit more, give the listeners a little bit about what Navidar does, what Latham Watkins does, because, listen, everybody, most people will know Latham. I know, Steven, you work for big firms and you started Navidar. Can you kind of give a super brief overview of what Navidar does and how it helps entrepreneurs?
Sure. First and foremost, we want to be a trusted advisor to that entrepreneur, in the context of a transaction or not. When that entrepreneur calls, we want to be an independent, trusted advisor. We want to be a place where they can bring literally any question, any concern, and have a discussion in a safe environment about it. You've heard those sayings that the CEO is the loneliest, spot, in a company. And so we often, are a confidant to the CEO, to the founder about a broad range of issues. And so I think that's the basis of these friendships that we've had over a long period of time. The second thing is from a transaction standpoint, we want to be able to help you facilitate a capital markets transaction. So whether you want to buy a company, sell your company, or do an investment, a capital raise, we want to be that partner to shepherd you through that process. And so we start with you day one and take you all the way to the point of funding. And so that in every step along the way, we want to sort of be the quarterback of that process.
Yeah, yeah. No, I mean, that's a really good summary of what you do. And I can definitely vouch that you've been a great, sounding board to me throughout the Think Power journey, post the Think Power journey, during the Cairo journey. I had a call like a couple of weekends back for an hour and a half to the evolution of Cairo, right? So that's a great thing that you're doing. I do want to add something to what Scott said about Navidar here, because I've been on both sides of deals. As you guys know, I was obviously a sold Think Power. And then when I was still running Think Power post transactions, I was involved in a couple of M&A transactions as well. And, Scott, you're 100% right. One of the deals we did, tens of millions of dollars. And the banker was there on the front end. I'm not going to name the banker or the firm, right? Banker was there on the front end. I mean, literally, they disappeared for the next 2 to 3 months. I mean, I'm not joking. Completely disappeared, right? And then here I am. I'm really, in many ways, helping the sellers out. I mean, these are family-owned company, helping sellers out understand different aspects of it, which Stephen helped me with, right, back in the day. And they just came back, and I saw the final cash flow, if you will, money flow, whatever they call it, right? And got their fee, but they completely disappeared, which was honestly very frustrating from a buyer perspective. I don't know how frustrating it was from the seller perspective, because they didn't get good advice. And to make things worse, their legal counsel was awful, right? And this is where I really appreciate having you, Scott, and Stephen on my deal, because the legal counsel, it is a tens of millions of dollars again, right? And they were negotiating, I don't know, $5,000 of AR and things like that. It was just, penny wise, pound foolish, as you put it, right? Not having the right focus on right things just made it very difficult to make the transaction. And I'm not quite sure they did the sellers any good, to be brutally honest, right? So that I just definitely want to emphasize, my personal experience there, both from a buyer as well as a seller perspective, and emphasize how important it is to have really, really good advisors, really good bankers, really good lawyers on your deal. So I want to add that to your point, Scott, and back to you, Scott. Maybe you can elaborate a little bit more about what Latham does, especially what you do, right? Because you work with a niche, if you will. Maybe you can explain that.
Yeah, yeah. As you mentioned, we're the second biggest law firm in the world, both by gross revenue and number of attorneys. I think we're still that, and so it's a big place. It's like I came here 4 years ago from another large law firm, but not nearly as big as this one. Um, I've been there for 15 years. A couple of the reasons I came over were resources and just the breadth of expertise and the level of expertise in all areas at Latham and Watkins. I think you know my practice is focused on helping emerging companies grow. I incorporate them. I help them raise money. We help, I kind of play what I would say point guard with my specialists, employee benefits, tax, technology, privacy, AI, all of that to help them through their growing pains, as they grow. I also do a lot of tech M&A, and in sort of two types. I think one is for the companies I've represented since the beginning that have raised a lot of capital. I think the other ones are very similar to what we did with Think Power. We have a company that's been bootstrapped, which, to be honest, may not make the most sense to hire a big law firm like Latham and Watkins just for day-to-day stuff. But when they get ready to exit, I think it's really important that companies reevaluate who their legal counsel is at that time of exit and whether their, historical counsel are going to be capable of, going toe to toe with the big law firm in that transaction. But I think generally speaking, Latham Watkins is global, which is really helpful. We've got lawyers in Asia, Europe, and throughout the United States. And as I mentioned, I'm in emerging companies. I'm a tech attorney, and being able to leverage, we've got the largest and most like prolific capital markets group in the world. We're on almost every IPO, either on the company side or underwriter side for technology companies. And to have that expertise as my clients grow is huge. And it's similar with M&A. I enjoy doing mergers and acquisitions, but having the leverage of one of the leading M&A groups in the world as well it's been a huge boon to my practice.
Yeah, no, that's fantastic. Thanks for that explanation there. So you briefly talked about entity setup. I know you set up Cairo, but let's kind of talk about maybe we can get into Texas versus Delaware, right?
Okay.
A lot of discussions around Texas now. Elon Musk is here. The Elon Musk compensation fight in Delaware, and things like that. Right? I know you may not be able to talk specifics because you guys may be representing one party or the other, but what's your take on where an entrepreneur should set up an entity, if there's any, and things like that?
Yeah, let's focus on the earlier stage private companies, because a lot of what Texas did is frankly to draw public companies to Texas, and may not be as applicable, but some of the stuff is still applicable to private companies. We've set up I think, 3 Texas companies that would have no normally set up in Delaware in the last 4 months that are going to raise venture capital and grow. Uh, some of that is sort of just Elon followers, I guess, in a sense. Others are people that have had bad experiences in Delaware in the past, and now that Texas is opening up the statutes to be more business friendly, potentially they want to be here. I think the main things for private companies that have been that I think the biggest thing is the codification of the business judgment rule, and essentially, which basically means that the court's going to give a lot of deference to the board and how they make decisions. Um, uh, if a stockholder is angry about something. And they've also essentially, I would say, initiated what's called the entire fairness rule doctrine in Delaware, which means like if there's a conflicted director, like let's just say uh, a venture capitalist director on a board is trying to convince that company to sell to one of his other portfolio companies. Um, in Delaware, there's a lot of processes to try to prevent being what we call an entire fairness land. And under the new Texas law, outside of fraud or a bad actor, there's, the board's going to be able to rely on the business judgment rule under these new statutes, which have been codified. In Delaware, these things have not been codified. And so I think a lot of companies that might, be concerned that they don't want to be they like, for instance, founders that want control of their company and maybe they're going to raise a lot of money with a lot of stockholders, but they want to continue to control their company and be able to sell their company to who they want to, buy who they want. They're going to want the protections that Texas is potentially affording them. Now, the other thing that Texas has put in place for the Texas Business Court. I just was taught it's a singular, not a plural, but the Texas Business Court is brand new. It's supposed to be sort of the corollary of the Delaware Chancery Court.
It's in Dallas, right?
Yeah, and it's interestingly, it's brand new, so there's not a lot of precedent, but the idea is it's supposed to be very business friendly. And what that means from my perspective is, again, deference and maybe the benefit of the doubt to the board and the company versus the stockholders outside of very extreme situations. We're gonna have to see how that plays out. I think the practical problem with Texas, which I'm sure that the current government's trying to solve, is just the Secretary of State's office ability to handle filings, whether it's your certificate of incorporation, a certificate of merger, and a transaction. Delaware historically has been able to do that in as little as a half hour if you spend enough money, but an hour, 2 hours. So if I'm closing a transaction, I need either, if it's a venture financing, I need a certificate of incorporation. If it's a merger, I need a certificate of merger. I can file it and get it back from Delaware in an hour, 2 hours. In Texas, it's always been maybe 2 days. Even if I expedite it, you're not sure when it's going to come back, and that can slow up a deal and potentially, a deal could die if something macro happens, or even with the target in the meantime. Now they're trying to remedy that. They've created some in-person same day turnaround at the Secretary of State's office in Texas, and I think that but at the end of the day, I think that the case law coming out of Delaware that has angered folks like Elon and others, or just, some of the unpredictability where it used to not be that unpredictable, is pushing people to Texas. Now, in Delaware's defense, they've tried to fix these things with statutory changes immediately after they happen. But, I think that there's still a concern that it's not as business friendly as it used to be, and that people are going to be wanting to explore Texas. And I think, we've been on the front end of that. Personally, if you ask me, for an early stage company, it's just easier to be a Delaware company. It's very possible your investors are going to require you to be, although Andreessen and Horowitz said, they don't want to be in Delaware anymore. So there's some major ones that are fine with it. But from all the form documents, the NVCA, National Venture Capital, they're all Delaware documents. So if you want to be in Texas, there may be some extra costs associated with it. But and the benefits could be there. Well, I mean, it's going to take 5 to 10 years to really understand whether these changes make a difference, and really there's going to be a lot of momentum moving to Texas, particularly at the private level.
Yeah, no, that's a really good explanation there. So,
Okay.
so anything you want to add from your side, Stephen?
No, I just think these are really important issues. We sold a company in Indiana and it came down to a final deal of a cash plus an earnout with a private equity firm in New York. And as we got into exclusivity, it became very apparent that the team had no interest in working and in staying, with this private equity firm. It was just a really bad cultural fit. And so we took the second bid and pulled them forward at the end of exclusivity, but it wasn't the highest total consideration bid. And if the business judgment rule allowed for that to happen, gave the board the autonomy to be able to make that decision. It sort of allowed the company to go on, be sold and combined with another private equity firm where they had a great experience and a great outcome. It turned into be a wonderful case study. But it's the importance of these types of choices. This is why we use a law firm. There's three conditions that Navidar has to work with us. One is that you accept our engagement letter on our terms, because we treat all clients the same. Number two is that you get an audit. And number three is that you hire a top tier firm. And most small companies really question us as to why they need a top tier law firm. But the reason why we've gone back to Scott and Latham so many times over and over is because you never know on a deal when an IP issue is going to crop up, a tax issue, an HR issue, a global issues. We've sold companies based domestically here, and we've restructured those deals to be cross-border deals. And so deals can take many different twists and turns. And what you don't want to do is have to spool up another law firm or have a law firm who doesn't know these nuances and miss them for you. That's the worst. And so it's just a requirement that we've made, and we've done that for 15 years. It's been one of the best choices, we've ever done.
So has anybody asked you to have they edited your engagement letter? What have you told them?
We have some entrepreneurs like those present company who have tried to modify our letter without success. But that's how great friendships are born, out of times of difficulty.
What happened to that lawyer who edited the engagement letter?
Yeah, I haven't seen him since.
But I think the other piece with when you're exiting your company that is or if you're doing a very complicated fundraise with an institutional investor, just even beyond the substance, you might have the smartest boutique law firm in the world that's been able to be perfect for you on a day-to-day basis. But, unless you're their only client, if you're opposite a Latham or another large law firm, those small law firms tend to get run over, not because they aren't smart and not because they're not good at what they do. It's just because these transactions move fast. There are lots of issues. There are a lot of questions and diligence. And the bandwidth becomes a real problem. And
honestly, Scott, they just don't know. Honestly, I mean, I've been on buyer side of a transaction where, like I just said, small law firm, maybe you just one or two lawyers, right? They just did not know. And multi tens of millions of dollar deal, you're negotiating $5,000. I'm like, clearly shows you have not been part of the transaction, right? And that really hurts their clients ultimately, because they don't necessarily look at the things that can actually come back and bite them down the road, right? Escrow money, which are millions of dollars and things like that, right? So
ask them if they've done it before, and ask them if they've done specifically what the transaction you're about to go through is, because I've had to say no. I've never done this before, but the nice thing about being in Latham is there's someone here that has, and almost always. And so if I have to bring a partner or a senior associate that's got an expertise that's needed for a transaction, I've got the ability to do that very quickly. And there's no ego in it. If there's something going on, like if it's in a specific country or there's a specific type of provision that I haven't seen before, I know that I've got a resource that can help me manage through it, that's got the pattern recognition, which I think is the most important thing in all of this, is pattern recognition in deals, to be able to help you through that. Because I think anyone's smart enough to figure it out and get through it and then know on the other side of it, now I know how to do that. But you don't want to be the client that's got to go through that with the attorney. Everyone's got to do something for a first time, but it's better if you do it for the first time with someone that it's got experience there.
Yeah, 100%. And honestly, even some of the big law firms, I wouldn't say big. I mean, maybe boutique. I've used them in the past, right? Stephen has used them in the past without naming names, right? In the sense that they got me into certain stuff that I really wish they hadn't gotten me into, right? They got me into this weird captive insurance, and I didn't want to be part of it, and it's still a pain that I'm dealing with, right? So you really want to make sure you have a really, really good law firm on your side and things like that, right? So let's talk about a little bit about, I really want to get to the exit piece of it, right? How different pieces of the puzzle come in. But, let's kind of wrap up the entity setup piece, because many, many entrepreneurs don't get this, right? Or get it too late, right? The importance of operating agreements, right? Your two friends get into business. I know friends who got into business didn't set up proper operating agreements. Now they're no longer friends, right, with each other. They're still friends with me. So how important it is to set up a good operating agreement, Scott? Maybe you can go first on this.
Yeah, I mean, I think it depends on what you want to be. Like, if you want to be a venture-backed company and you're going to be building a product that might run at a loss for a while as you grow, maybe you want to be a corporation. And then, that's mostly what I work with. And there are all sorts of things we do to protect companies, which I'll get into in a second. If you're going to be a company that may not take a lot of money to grow, it's going to be profitable quickly, then there's some benefits to being an LLC. Uh, an LLC is a pass-through entity; it's not taxed, and a corporation is taxed. So I think, but either way, if it's multiple founders, the key thing you've got to remember is that you just set, when you're doing your formation documents, is to set ego aside and think through the scenarios where someone decides they need to leave. Like, because what you don't want to have happen is like it is like a 60-40 deal or a 70-30 deal. And then one of those people, particularly the person that has more, but really either one, says they want to leave. You need to have a mechanism set up so that equity comes back. And the way we normally do it is founders vest over, if there's multiple founders, they agree that they're going to vest over 4 years. And if they leave before those 4 years are up, some proportional amount of their equity goes back to the company. In LLCs, sometimes it's a buy-sell arrangement, but it's not at a price where the company's got to pay for it, right? It's at a price, it just kind of goes back. And because otherwise you've got debt equity on your cap table, it's going to make it hard to raise money, and it's going to create adverse and like sort of perverse incentives at exit. And so you just think about how you want to handle if someone leaves early, even if no one intends to, because life gets in the way, and it may be completely friendly. Someone just says, I can't do this anymore. And we need to plan for that. I think that's the most important thing early on. I mean, we could talk about entity formation. That might be a whole other podcast, whether it's an LLC or a corporation. But generally speaking, multi-founder corporations should have a plan right when they start about what happens if someone leaves.
Yeah, 100%. 100%. That is something people don't think through, because they think that it's going to be forever, right? Yeah. You need to think through, hey, life comes in the way, things happen, right? You never anticipate, and you want to give yourself the best shot of success, because, if you're having to, I've seen these situations, what you're talking about, where, the company has to buy one of the founders out. They don't have money to grow. They end up with cash flow issues that affects the company in the long run, and all these kind of things comes into play, right? But you're right. A venture capital raising corporation. You set up Cairo, obviously, right? Cairo's corporation. Think Power. I set it up myself, LLC, right? So, Steven, from your side.
Yeah, I totally agree that the exit is really important to figure out up front, and then the valuation. The two nuances I would put around that would be, number one is keeping the company record keeping on a GAAP basis eliminates one partner's desire to manipulate a choice of accounting one way or the other that might impact a valuation. So understanding the valuation approach and framework to exit that partner, when that would be paid out and how that would be paid out, I think that's really important. Then there's the other gray zone, which is that in between, where a partner's not acting in good faith. and is trying to stick around to get their 4 years vested, but not delivering what they said. And I think that's probably the hardest scenario to deal with, but really trying to think through what are the mechanisms and what are the bars that somebody has to hit in order to remove them, even if they don't want to voluntarily go. Those are the things where I've seen the sticky points.
Yeah. Okay. Let's get to exit because, honestly, I really want to focus on that, right? Because, I've seen all kinds of weird situations. You guys have seen probably worse, right? One of my friends did a deal, which I think, Stephen, I told you this a couple of weeks back, where I still don't know why I did the deal, right? It's like, a private equity firm approaches him or her. They initially say, here's the deal. And then as the transaction goes with no advisor or, not a great advisor, bulk of it becomes an earnout, right? And it's an all or nothing earnout, right? Meaning, an example is, hey, if you're hitting $25 million in EBITDA, you get X amount of money. But if you're 24,999, you don't get it, right? So lots of poor things happen, and people don't want to listen, right? So, and even some of the successful ones, like Mark Cuban, for example, right? He sold the Mavericks to the Adelson family. I'm a huge Mavs fan. I'm pretty pissed off because they traded Luka Doncic, right? And then since then he's come on local sports radio, which I listened to. Said, "Hey, I don't regret doing the deal, but I regret how I did the deal. I should have gone out for a bid. I should have hired a banker, things like that." Which many of the football teams that have recently sold, they've done that, right? Hired big bankers and things like that. So. Importance of going through a process, Stephen. This is obviously a super important sweet spot. So maybe you can take that out. And I know I probably explained a little bit about why they should go through a process. Maybe you can take it on from your side.
Yeah. Well, the challenge is we spend a lot of time in the middle market, and we come across a lot of entrepreneurs who did not go through a process, and we hear a lot of horror stories. And we also hear about a few who they were approached by one or two parties. They hired a local banker, a nightmare, outcome, and deals didn't close. And incredible amount of wasted time and money and emotional breakage from that approach. And so we're we're adamant about a methodology that works. And the methodology that works is to do an extreme amount of preparation, like you saw us do with your company, and to really have the company prepared from a legal perspective, a financial perspective, operational perspective. And that might take 1 month for some companies, and it might take 9 months for others. And we've had everything in that range at Navidar of taking 1 to 9 months to get somebody ready.
Oh, we lost your audio there, Hari.
Yeah, you're on mute.
Sorry. For me, it took 1 year. I just want to let the audience know, because it's like, I remember we started the deal on June 9, 2021, closed on June 9, 2022. I remember those dates because it's my grandfather's birthday, right? So it is a solid 1 year deal for me at the end of the day. I mean, it takes time, right?
Yeah.
There's issues in my mind that you may not encounter in others.
Yeah, it takes a lot of time. And the benefits of doing the process correctly and contacting all potential parties and getting all bids in at the same time on the same day is this. Bottom line, it allows you to get a higher sale price. I mean, bottom line is it puts more money in the entrepreneur's pocket. And number two, it reduces risk that they lose some of that money post-closing because they breach a rep and warranty. So what usually speaks for the entrepreneur is cash, and you just end up with more cash. That's just the bottom line. But along the way, it's so much easier. I sit on panels with bankers all the time, and they talk about the exclusivity process and what a nightmare and how many heart attacks everybody had, and everybody's fighting, and the deals get extended and deals get retraded. And they talk about this horror story between the signing of exclusivity and closing of the deal. And it absolutely doesn't have to be that way. We sold a company to a serial acquirer. They had purchased 22 companies on this platform by the time they came to do the deal that we were working on. And in their exclusivity, they asked for 90 days. And we said, this is crazy. This should be a 45 days close. It's a simple deal. It's one owner, et cetera. And like, we have never closed a deal in less than 75 days. So we'll give you that and we'll ask for 75 days. And we said, look, we'll make a deal with you. You set out your calendar, you set out your timeline. And if we miss a single due date, we'll extend it from 45 to 75 automatically. And if we miss 2, we'll extend it to 90 days. We didn't miss a single deadline. We closed in 45 days. They said it never been done in the history of their deal making, right? That's the importance of process. And if you bring in your attorney early, you bring in your banker early, you get your accounting work done early, then it can be very, very quick. And I'll just give you one other little tip. If you have a banker who's telling you not to do an audit and to do a sell-side Q of E, right there, you know you have a lazy banker. There's no replacement for an audit. There's no replacement for doing it right and building it right from ground up and doing it a GAAP basis. You don't need to pay for a Q of E if you've done your financials correctly. The buyer is on a private equity firm side is always going to do a quality of earnings analysis. They're not going to accept yours. And you'll be prepared for that if you've done the proper financial preparation. You won't be surprised by what's in that Q of E report. So bottom line is there's no substance for putting in the work. There's no substitute for putting in the work and getting a phenomenal outcome. And the end of the deal doesn't have to, it's always going to be stressful, but it doesn't have to be a nightmare.
Yeah, no, super eloquently said. I'll make you look good about it. I'll bring a smile on your face. Cairo, from year one, has audited GAAP financials.
Excellent.
So you'll not have the nightmare that you had.
Yeah.
Eventually, hopefully, there's an exit, and it'll be hopefully a smoother exit, right? So,
Yeah.
Scott, from your side.
Yeah, no, I agree. I mean, I think if you hire a banker transactionally, it's going to be a transactional experience. It's the same with attorneys. I mean, I have groups at our law firm. I look at myself as a general practitioner, and we definitely have groups that I see as surgeons, and they come in and they do the deal and they come out. But I keep the overall relationship, and people work on deals differently. That being said, even those folks, the reason they're so successful is they have relationships with the people that are serial acquirers or just, that are, multi-time entrepreneurs and have exited multiple times. So, you can't come in as a service provider and be like super transactional about it and just sort of focused on yours. You have to be there to help the client if you want the work. And, from my perspective, having diligence for the buyer in order and ready to go, both the legal and the financial, is huge. So obviously an audit and a clean Q of E that the banker's been able to do for you, and your accountants as well, and having it ready to go makes it so much easier for the buyer. It allows you to do a 45-day process instead of a 90, because I'm guessing that company bought a bunch of messes. And so the reason it took them 90 days every single time was because they had to go do the work that, Navidar would do for you before. And I do think a lot of companies engage bankers and jump right into the process. And sometimes circumstances and timing, that's just how it had to work out. But, if you see an exit on the 18 to 24 month horizon, you should start talking to bankers, because, and if you've got VCs on your board or other institutionals on your board, I mean, hopefully they're smart enough to figure that out. I think a lot of people are worried about the fees, but if you don't close a deal, or if, the fees are for when you close. And so, I think that's why I think folks like Steven and Navidar, they're good, because they come in, they're more relationship based, as are many other banks, but just that's what you want to look for. You don't want to I have to sell my company by 12/31. Let's go and engage a banker. That's, maybe you end up having to do that because of circumstances, but that's going to make a tougher experience, I think, than I would like to sell my company by 12/31 of next year. Let's go start talking to bankers. And I think that's the way I'd look at it. And then from a legal perspective, I would, even if you don't have institutional investors, so no one's done diligence on your company before, the more you can keep stuff in order, your HR files, your commercial contracts, your vendor contracts, your open source downloads. Like all of that, have order to it. It may not be perfect, but if it's all over the place, if you've got a bunch of documents in your system that are signed by one party and not the other, if you've got missing contracts, if you've got oral contracts that you're working off of and have never been papered, those are all going to be problematic in diligence because the buyer, especially if it's an institutional buyer, they've got a process and they're going to want to overturn every stone, and they're going to make everything a big deal, even if you don't think it is.
Yeah.
And so the more you can be clean when you start the process, the easier it's going to be.
Yeah.
And
Information arbitrage, right? They don't know what you know. So they really are going to be always careful about it, and they have to be. And again, I've been on both sides. I've seen that, right, where the other party feels they're violating their trust. Why are you doing this? Why are you asking for this? But honestly, I know my company really well. I really don't know somebody else's company, so I really need to see the documentation. And if you don't have it right, that means you don't have it, right?
and an example of something that was super silly, but a buyer is going to use it as leverage against you is I had a client that was like a 10-year-old SaaS software company. This deal was about 9-10 years ago. And but they had a lot of contracts in boxes in a closet, and they pulled one out, and there was one from like the first 2 years of the company that had promised that the customer would own the customized source. Now the issue is this customer had been bought 2 times over since that, like 9 years later, and frankly the company that bought them didn't even have that business line anymore. So like the risk was super low, but all the buyer saw was this, hey, some of your IP is owned by somebody else. How do we know that this isn't going to be a problem? And you don't, and everything you did wasn't developed off of this. And so, these are things like you want to be super careful about early, because you might not think it's a big deal. Your lawyers may even advise you that the risk is super low, but the buyer, even if they know the risk is super low, they're gonna use it to extract.
It's a leverage.
The deal.
Right?
Yeah.
It's a leverage point for them, right? So that's good. So, Stephen, back to you now. Purchase price consideration, cash-free, debt-free basis, things like that, different components that goes into a deal, right? Rollover equity, indemnification framework, right? You got the fundamental reps, survival of general reps, amount of escrow goes into it, things like that, right? So whether the escrow is the sole source of recovery, there's breach of fundamental reps, all these kind of things. Can you kind of elaborate a little bit? Size of the tipping basket. Can you kind of elaborate a little bit? Because most entrepreneurs, I did not know this. Honestly, I had no clue about any of these things. Right? How does it matter to an entrepreneur?
How's it what?
How does it matter to an entrepreneur? How do they evaluate a deal? How do you come in and explain all these things?
Right. Okay. Well, so I'll say a couple of things, and it may sound like a broken record, but ultimately, at the end of the day, it's all about how much cash stays in the entrepreneur's pocket. And there's a couple of parts of the deal making that are very esoteric, and this is one reason why it's very important that your banker and your lawyer are on the same page, because these legal issues, they kind of blur between, having a business element to them and kind of a business decision to them, and then they have a legal underpinning to them. Okay, and so it's important that the banker and the lawyer are on the same page around these very esoteric areas. So just number one is an escrow versus a reps and warranty deal. So an escrow is you leave your cash behind in a trust account, and the buyer has 1 or 2 years that they can go after that cash if you breach a certain rep. A reps and warranty deals have an insurance company stepping behind that deal, and so you have to leave less cash behind, a lot less. In that scenario, number one, I'd just say the reps and warranty market has continued to come down market to smaller and smaller deals. And so it's more and more accessible. It used to be for the very large deals. So that's something that you need a banker and attorney who are familiar with that product and familiar with the pros and cons of the two approaches and can walk you through that nuance. So that's one that really matters, how much cash you leave behind. That's how much it matters to the entrepreneur.
So let's give a quick example for most people, trying to help them understand this. So let's call it as a $10 million deal. Ease of math, right? An escrow, ease of math again, 10%, the entrepreneur leaves $1 million into an escrow account. And if there's a breach of, some rep, right? You can explain that. The buyer, I'm the seller. There is a buyer. The buyer has access to that cash in the escrow account because the deal didn't go as they thought they would, right? For a variety of reasons. That's an escrow account. And reps and warranties essentially is it's same purpose at the end of the day. If there's a issue, but there's an insurance that both parties, or sometimes it's one party, pay a premium to, so that more cash sits in the entrepreneur's pockets, if you will. Is that a reasonable way to put it?
That's right. Yeah.
Okay.
Normally we see that the buyer and the seller split the premium, or if it's a very competitive deal, then the buyer will pay the cost of premium for the insurance. But it's basically kind of one of those two scenarios. And then the insurance company stands behind it. But you still have to have done the due diligence. They still have to have the same types of reps and warranties. It's the same, kind of legal, uh, framework, which Scott can share more on that you would in a regular deal. So you do largely do all the same type of work. There might be some places around the margin where a reps and warranty deal might make it a little bit easier to come to an agreement on terms and conditions, but by and large, it's the same document either way. It's just a matter of who's stepping behind the reps and warranty. Is it your escrow, your cash, or is it an insurance policy?
I think the important piece for this, because you're right, the insurance, reps and warranty insurance has definitely come down market. Like we were talking $10 to $15 million deals. That would have been unheard of a while back. And what's funny is way up market now, people are starting to self-insure, buyers are. So which is, whether that, that'll be harder to push down market than reps and warranty insurance. But I think it just depends on the size of the buyer. But what you got to remember is that the buyer is hiring an insurance company to rely on to be able to make claims against if there were breaches by the selling company. And so what I find in reps and warranty deals, there's actually an additional cost of diligence because the buyer actually has to do the amount of diligence that the insurance company requires in order to be comfortable underwriting the deal. And so there's always when you do these deals, and you remember the call with buyer's counsel, Hari, where they ask you all of these questions about your business. Well, there's a subsequent call if you're a buy-side counsel with the underwriter's counsel, where you're basically acting like the seller and they're asking you about the company that your client's about to buy. And it's the same exact call. And because they want to make sure that buyer's counsel has done enough diligence on the deal that they can stand behind all the reps and warranties that the seller's making. Because what we see in these reps and warranty deals, particularly if it's 100% reps and warranty, the seller's like, yeah, I'll give that rep. I'll give those reps. That's fine. And unless it becomes a burden on disclosure schedules, like, the seller kind of like puts its arm in the air and it's like, I don't need to negotiate these because it's covered by the insurance policy. So it puts a lot more work on buyer counsel. But that means buyer's going to be in the weeds with you a lot more than they might be on another deal where they get to put 10% of the cash in escrow. And to Stephen's point about cash is key, and it's all about securing as much cash or consideration if there's stock in the deal upfront as possible. I always tell my clients, if there's a structured deal, if there's an earnout, you need to be comfortable that you're not going to get it. And if you're comfortable that you're not going to get it, you should consider not doing the deal, because most buyers I've found play fair, and they actually, if the earnout's made, everyone's won, and so they're happy to do it. But there's certainly buyers out there or circumstances where the buyer might not want to pay it, and so they're gonna figure out, they're really hard to negotiate. They're very we've got to think about up front every little hole that a buyer might find to try to avoid it. We often tell buyers, you can't do anything to harm our ability to get the earnout. And their response is, well, what if it's in the best interest of our stockholders as a whole to do that thing that's going to cause you not to make your earnout? We can't agree to that because we have to think about our stockholders. And so, and it doesn't mean that you were going to lose that point. It's all about leverage, and as is everything. But it can be a really tense negotiation and I just think that it doesn't mean you shouldn't do an earnout. You just need to understand that, okay, what are the possibilities of getting it? Because I think that I would say more often than not they're not hit. I mean, there's a million permutations of what an earnout can look like, and so some are more certain than others depending on the terms, but and some are meant to be more certain than others. But I think it's still you got to think of it as contingent because that's what it is, and some of
Yeah.
it is going to be out of your control post closing.
Yeah.
I agree with Scott's, perspective on a lot of things on earnout and Hari. We could do a whole session on earnouts, okay?
Yes.
Because we're
I know.
incredibly passionate.
I've read your beautiful piece on Navidar's website by Tim
Yeah.
Walsh. For people considering an earnout, I
Yeah.
really encourage them to go to Navidar's website. And I read it to educate myself. But, when my buddy went through this deal, I really questioned the wisdom of the advisor. But keep going,
Yeah.
Steve, on
So
that. So.
here's what I'll say about earnouts. And I'll say a couple of things that are going to be very controversial and a little bit of a lightning rod, okay? But that's okay because I want entrepreneurs to really listen to this. At Navidar, over our 15-year history, 90% of available earnout dollars have been paid to our clients and in our clients' pocket. And that's an incredible track record, and we brag about it and we're proud about it because we put so much work into it. But here's what I'm going to say about earnouts. When an earnout is not earned, usually the fault can lie with the banker or with the seller or a combination of the two. It's very seldom an issue with the buyer. I have found most buyers are highly motivated to want an earnout to work. They want those companies to hit those projections. And some of it starts very early in the process when the banker doesn't prepare valid projections. And then you get to the end of the deal and you want to set an earnout on those projections, which are pie in the sky and not valid. You can't then say, hey, we're just kidding about those projections. We want you to bring those projections down and set an earnout on a lower number. They're not going to do that. So you're stuck with them. And now you got to live with them. And whether you put a sliding scale or an all or nothing, they're still unachievable. And I just want to tell you the power of this. The entrepreneur who's selling needs to be an honest participant in the development of the projections. And I'm going to tell you there's some case studies where Navidar has had an incredibly confrontational discussion with a founder about the projections. I'm just going to give you one that really highlights it. It was about 35% of the deal was in an earnout. Okay. And the earnout was going to be based off of revenue growth and EBITDA. And the founder really felt like his company was going to achieve a 19% EBITDA margin in his business. And that would obviously been a lot better for his earnout value, right? And we said, no, we don't see this business getting past 12%. And huge fight over the set of projections. You're costing me money. I'm not going to get the valuation that I deserve because you're taking money out of my pocket. Anyway, we won the battle, if you will. And fast forward at the end of the 2 years, when he got his 2 earnout payments, he got 100% of his earnout. You know what his EBITDA margin was? It was literally like 11.95%. He never got above the 12 because Google marketing, online marketing, the success of it continued to change. The algorithms continue to change, and he couldn't get the return off of his investment that he was hoping to get. And we've seen this in the Google algorithm world in our 25-year history. And we knew that this would be a potential risk, although we didn't know for certain. So bottom line is, by holding firm on the EBITDA, he got 100% of his earnout and ultimately got more in valuation than he would have gotten had he gone with his 19% margin. So the banker and the entrepreneur must have a trusting relationship. They must be honest with each other. They must work hand in hand and really set that foundation at the beginning of the deal for the earnout at the end of the deal.
Yeah, and at the end of the day, there should be a healthy amount of ego on the entrepreneur's part, but not too fragile to say, hey, you know what? I'm going to make a 30% EBITDA margin on a business that's potentially going to make half of it, right? So no, it's really a great segue into the next piece of the puzzle, right? Which some of it, Scott, you hit on, which is the networking capital, if you will, right? Some of these things get super, Steve, it's super near and dear to your heart. So maybe I'll let you go first, right? So networking capital, how can deals fall apart? And this is why is it so important?
From my perspective, a lot of it ends up not being legal, but it is a question we ask when we draft. If we're doing sell side and we're putting an agreement into the data room for people to mark up, or if we're buy side and we're drafting the first draft of the agreement, is like what's going to be in working capital. And I think that the typical way to look at it is most of these deals are what we call cash free, debt free deals. So you take the equity value, you add the cash at closing, and you subtract the debt, which there's a lot of different components of debt and that's the enterprise value the equity value of the transaction. And so enterprise value plus cash balance debt. So that's the equity value, and that's what the shareholders are going to get. And the question is, okay, the working capital is basically assets less liabilities. So you take cash out of the assets and you take indebtedness out of the assets or out of the liabilities. And so the question is, what is a liability and what is indebtedness? And that's where we see the most negotiation as it relates to the definition of working capital. A lot of people look at, and I think market's pretty much gone here, that any taxes that are owed for pre-closing periods are actually part of indebtedness and come off the purchase price dollar for dollar. Liabilities like, payables and things like that, that's part of working capital. But there's things like deferred revenue, deferred purchase price, deposits that folks will try to argue belong in indebtedness and not working capital. And at the end of the day, it really depends on the business. It's very business specific. Like, how long is that revenue deferred out for? How long are the deferred purchase prices out there for? And I think in SaaS software, that stuff becomes it can be heavily negotiated. I'd like to think that everyone understands what working capital is and what the components are and what the components aren't, but it can be very business dependent. Like, because things that look like debt, even if it's not traditionally thought of as debt, the buyer wants to treat that like debt, and you got to convince them otherwise.
Yeah. Stephen?
Networking capital is the biggest boogeyman in any deal making. It's very hard for entrepreneurs to get their heads wrapped around it when they're not, experienced sellers. We spend a lot of time on it. To Scott's point around SaaS software, a lot of the stories that we come to, they don't have GAAP financials, so they're not even familiar with the size of their deferred revenue on their balance sheet, and then you come into this situation and a buyer is trying to treat it like deferred debt. And, we can have some pretty small SaaS software companies, and they'll have $5 million of deferred revenue on their balance sheet, or they didn't know that they did, but they do. And then somebody tries to treat that as a debt-like item, and it's $5 million off the purchase price. It's like, whoa, how did I just lose $5 million? So we obviously try to put it into working capital. We also try to negotiate that it should not be a one-for-one hit, because there's not, 100% of the deferred revenue is not required to be there to support those accounts. So to Scott's point, it's heavily negotiated. We try to get that on the deal. That's a total technical nuance point that we try to flesh that out at the LOI stage, which again, I think is much earlier than most bankers would try to flesh that point out. But to us, it can be the real difference. On networking capital, we like to joke is, we're fighting for the beach house for you. It's not a deal mover overall, but we've had deals where we've been really fierce negotiators, and it ends up being $1 million extra to the purchase price to the founder by setting an appropriate networking capital target. So it's something that we think about early on. We think about it before we get to the LOI stage, and we try to flesh out if we think there's going to be issues around it. We try to flesh it out at that stage. So again, we don't get to the back end of the deal and somebody feels like, oh my gosh, I just lost $1 to $5 million in my purchase price and didn't even see it coming.
Yeah.
I think the other component and Stephen was alluding to it, is not necessarily the components of working capital, but how the target's calculated. And usually if a company's got pretty, steady state revenue, you just look at the last 12 months, come up with an average, or the last 6 months, come up with an average. But some companies have very lumpy revenue, and it's hard to, like, on a month-to-month or quarter-to-quarter basis. And it's hard Are we looking at the right 12 months? Are we looking at the right period? Are we calculating it right?
And some companies may have had a rapid growth, which when I went
Yeah.
for a deal, ThinkPower had a super rapid growth in 2021, right? And it's hard to calculate, right?
Yeah.
So
And so when you come up with the target, what's going to happen in the transaction is you're going to have a target that's based off of some pre-closing period. And then at the closing, you're going to say, this is our estimate of what working capital is at closing. And at the closing, if that estimate is below the target, your purchase price is going to get deducted by that much. And if it's above the target, it's going to get increased. So for a seller, the lower the target, the better. But then what's going to happen post closing typically is there's going to be a true up because we're just estimating it at closing, and then there'll be another true up. So as a seller, you don't want to cook the books at closing to make it look good. You want to get it as accurate as possible so there's not this like big post-closing adjustment. But to the original point, the reason the target is so important is the target isn't what it is at closing. It is a target based, and then that's how the buyer theoretically valued the company. And you know, that's why that discussion happens pretty early, because like we value this company at $100 million based off a working capital history of this, but that doesn't have to be the right answer when you go to the definitive docs. If as a seller you can give it some, like, you calculated that wrong.
yeah,
So it's a discussion. But to Steven's point, it's a big deal, but it shouldn't be a deal breaker unless for whatever reason it's a small enterprise value and very very significant deferred revenue, for instance.
got it. Got it. No, it's good stuff. So I know we talk about earnouts, but another piece of the puzzle, which is important for many entrepreneurs, is rollover equity, right? Why is it important? When should somebody roll over a lot of equity, which I did, right? In the ThinkPower deal, maybe Steven, you can go with that in the thought process behind how you negotiate that piece of the puzzle.
Sure. Well, rollovers is one of those things, and Scott mentioned this earlier about things being highly deal specific, and that is one where I would say is really incredibly deal specific, not only to the seller but also to the buyer. There are some buyers in the private equity world who will only want to buy 100% if it's coming into a platform company. And that's just the rule. Of course, if you're selling to a publicly traded company, there's no such thing. You're selling out 100%. And so now you're kind of into this middle ground of private equity firms who have a portfolio company, or they're investing in you as a platform company. And a lot of times, if they're investing in you as a platform company, they want to see you stay and they want to see you roll over a lot of equity. And so just to clarify for people what a rollover is, you're still selling 100% of your company, but what you're doing is you're, at the time of closing, you're taking part of your proceeds and you're buying back in to your own company at the share price that you just sold at. That's basically what you're doing. And there's a lot of times where if you are the platform investment that a private equity firm is making, they would love to see you continue to own upwards of 40, 45% post-closing. And they certainly would love to see you own 30%. Now, I'd say kind of
that gives them the confidence that you believe in your company.
That gives them the confidence that you believe in it, that you're going to stay around, that you believe in them and their plan. I'd say that the minimum, and if it's a platform investment, the minimum that they'd want you to roll is probably 10%. I mean, 10 to 20% is kind of that minimum range that we would guide people to expect. And if they're going to stay on board, perhaps as much as 40, 45%. Now, our advice to entrepreneurs, again, is very highly case specific. But if I had a general rule, I would say if you're staying and you believe in the plan and you believe in what they're bringing to the table, then rolling 45% can make a lot of sense, because your second bite at the apple, which we like to say is the second sale down the road, 3 to 5 years down the road. A lot of our clients have made more in the second transaction, even though they only own 45% of the company. They make more money in their second bite at the apple in those scenarios. Now, if you, for whatever reason, you're ready to retire, you're worn out, you're not that confident in the competitive landscape, you're not going to have that much control inside the private equity firm to operate in the way you'd like to operate, you're worried about cultural changes, things like that, then roll 10%. And if it's really important to you that you roll 0, well, then you need to know that that's going to reduce the number of buyers. It's going to reduce the competitiveness of your process. It may result in you getting a lower purchase price as well if you do that. But that's basically how we think about rollover in our general advice around it.
Yeah, that's beautiful, eloquently put out there. Scott?
Yeah, I mean, I think if you're getting acquired by private equity, you're going to be expected to roll something as management, almost certainly, particularly as Steven said, if you're a new platform company, unless you're just going to completely replace management, which I guess happens, but I wouldn't say in the middle low markets, it's typically what they want. I mean, they're going after these founder-backed companies, and there's a lot of successful private equity firms that do this. They don't want a company that's been venture-backed and had 3 rounds of capital. They want these founder-backed companies, and they want to continue to support the founder to grow the company. The thing you have to worry about is as a rolling stockholder, and I'll caveat this is all about everything's reliant on your leverage in the transaction. Is okay, what does my equity look like? And there are a few things that from my perspective are fair in our market for rolled equity. Some private equity firms would disagree with me. Some private equity firms might go differently just based on the leverage of the transaction, like if it's a distressed deal or if there weren't as many buyers for the seller as and they need that. But one is you should get the same equity that the private equity fund's putting in.
Yeah, that's a very important piece of the puzzle because, just if I can pause you there just a little bit. I remember, Steven, Scott, you and I, the 3 of us evaluated multiple private equity partners, and there were a couple which we kind of weeded out because they wanted to issue me a different class of stock, although they wanted me to roll significant piece of the puzzle, right? 40%, something like that, 30, 40%, which is a deal breaker, right? Which actually happened more often than people imagine. It's not a good situation to be in at the end of the day, right? So
yeah, and like I want to again, it's all about leverage. It's all about who wants to buy your company. It's all about who's going to be the best partner for you. And there are funds out there that's part of their internal controls is we have to be senior. And so if you're going to choose that fund, well, the valuation is going to need to be higher. Maybe my role is a little less than it would be because I don't want to, and maybe I want some other protective terms as a result of that. So I don't want to say like, don't do that deal.
Or maybe you don't have a choice. Honestly.
Yeah, maybe you don't have a, but there's other reasons that maybe that deal's better, or or maybe it is a tuck into a already there existing platform company that's just a super. But circling back, so there's that. You want the same type of equity. The other piece is that stuff that equity has been fully vested for you almost in every case. That's fully vested equity. That should continue to be fully vested equity when it rolls. It should not be subject to clawbacks outside of you being a very bad actor.
Yeah.
We see the first draft of like LLC agreements for the platform company from private equity funds that her founders will say, look, I know you're rolling 40%, but if you leave, I get to buy it back from you at cost, or I get to buy it back for you at the lower of the fair market value. And you want to avoid as many of those clawbacks as possible. Now it's in the private equity world, you're not going to avoid the clawback for being a bad actor. But there's all these different things called good lever, bad lever. There's even I've seen like intermediate levers recently, which is super interesting. Where there's sort of different levels on how they can claw back your stock if you leave the company based on how you leave the company. And I think the reason they want to do it is like if you roll 40% and then you leave a month after the deal, you're on their cap table for 40% now. And it's sort of similar to what we were talking about with founders earlier, is like now they've got this cap table. So there's going to be a negotiation there, and you want to try to limit the ability to claw back that stuff that you've already earned. You've already earned that equity, and it's just rolled into a new company.
Yeah.
Now, other equity you might get grants out of an employee equity plan as a founder under this new platform company, and those are subject to different rules. Those are subject to vesting and maybe more intense clawbacks. So I think again, saying it again, it's all about leverage. But these are the things you should be trying to ask for if you're rolling. He's like, I want equal equity and I don't want any clawbacks. on this rolled equity.
Put yourself in a good position where you have more leverage.
Yeah. Well, I mean, I mean, because then the other things that come down to it are governance controls, because you no longer control your company. And the private equity fund, as they should, needs to be able to operate the company the way they want to operate it. But you want to protect yourselves against self-dealing, smashing together two portfolio companies. You want to protect yourself against maybe there's a management agreement with the PE fund and the portfolio company's paying fees. Well, if you own 40% of the company, that's 40% of that value going back up to the PE fund is your money. So if they want to amend it and increase the fees, you should have to be able to approve that. Anything that's like a related party transaction with the portfolio company and the PE fund or the PE fund's other portfolios, I want to have a blocking right on that if I'm a founder that's rolling a significant amount of equity. And it's all, again, it's leverage. It's how much are you rolling? If you're only rolling 10%, you're going to have a lot less to argue about, and you're going to have a lot less leverage, and you're going to get a lot more pushback. If you're rolling 45%, you should be really concerned about these things.
Yeah. No, fair point on that. I mean, those are all things that I'm obviously super familiar with, and thanks for negotiating a great deal from me, right? So on the, we're kind of 10:55 mark, right? So let's talk a little bit about disclosure schedule, because, candidly, first time entrepreneur, me,
Mm-hmm.
when I was going through this deal, I really did not know what the hell disclosure schedule was, right? And I had to understand that, explain to an average Joe out there starting in a new company what it is and why is it so super important on that.
The best analogy is if you're selling your house and you have to do a seller's disclosure for your house and everything that's wrong with it. It's pretty much the exact same thing. And so you're making a set of reps and warranties in the purchase agreement. And there's two types of disclosures. Sometimes those reps and warranties say, list every contract that's more than $100,000 in revenue. And it wants you to list those contracts. The other disclosure would be the company has no current ongoing litigation. Well, you do. So you list those litigations in the disclosure schedule. And from my perspective, there's a balance there. Buyers should be able to flush out as much as they can to a reasonable level, particularly if it's a reps and warranty insurance deal where they're going to want more reps and warranties. You're going to care less about the reps you're giving because it's covered by their insurance policy. But you don't want to have to force a seller to disclose 1,000 contracts. And I think, from a seller's perspective, when we're negotiating and it's a reps and warranty deal, what we're really focused on is this sort of beyond the pale on the amount of disclosure we're going to have to provide. It's just like not worth it. And it's just a waste of time. And if it's not a reps and warranty deal, we may be a little bit more, we're going to negotiate the reps harder and maybe avoid making some reps that we prefer not to make that might be riskier. But from my perspective, the disclosure schedules are a process that you want to get started as soon as you're able to. Usually that means if you're doing a process with Steven, we've drafted a seller-friendly agreement with some reps and warranties that are middle of the road because we want reps and warranty insurance. So we're not gonna throw up seller-friendly reps just because we can. We want something that a buyer isn't gonna mark up heavily. And we get started on disclosure schedules before we even have a buyer in the door, so that we have something that's already a working document. There's other deals where the buyer sends you the first agreement and it's got the worst reps and warranties you've ever seen. And we want to kind of understand maybe a turn or two where we're going to land before we start disclosure schedules. But it can be a very intensive process. There's going to be a long call with your counsel to walk through all the reps and warranties with different members of management so we can flush out things. Because, ultimately if something happens that wasn't disclosed, a buyer's first inclination is you hid it from us. You did it on purpose. That's fraud. Yeah. And usually that's not the case. Usually it's just got missed and and that somebody at the company knew about it or forgot about it. And when we had the call and, we didn't know that there was this email threatening litigation about this certain topic. And you want to avoid that, but ultimately, and that's why we have those sort of intensive calls where we trade, are we sure we don't have anything else? But it can be a gating process in a deal. if you're not working on them early, and if you're not working on them with the right people at the company.
I would
Yeah,
say,
no.
Ari, on this topic, before Navidar,
But, hey, Stephen,
Yeah.
I just want to jump in here just 1 minute.
Yeah.
Scott says it real estate. I compared you to a real estate agent, so he's doing the same thing there. Right?
not much difference for sure. So that's funny. So I was just saying this disclosure schedule is before Navidar, we did more buy side than sell side. So I worked at Goldman Sachs. We did mostly buy side M&A, and from that experience, what I say to sellers is when you go into exclusivity with a buyer, you're starting with a jar full of trust, and each time that you miss something, each time you fail to disclose something, you're distracting, you're taking away from that jar of trust, right? And at some point, the trust level will get to a spot where they'll just walk away, right? And so the importance of this preparation from the legal, the accounting, and the banking perspective up front, the importance of starting on disclosure schedules early, the more that you're prepared, we have a goal at Navidar. It may sound unrealistic, but we literally have a goal that we don't want a buyer to find out anything about our company that we don't already know. That's rule number one. That's our bar, that in due diligence, in the disclosure schedules, no new information. The second thing that we do that I do think is very unique is we want all of that priced into the bid. The good, the bad, the ugly, we want all that in. There's very seldom any situation that we don't make sure that's baked into the bid price. And I think that's a fundamental flaw of most bankers. They think, well, number one, they don't even know what they don't know because they haven't prepped properly. And then number two, they're like, oh, well, we'll deal with that in due diligence. Let's not disclose that now. I think that's a fundamental flaw, and it gets to that erosion of trust. And so that's what it's all about. Getting from the signing of an LOI to closure is about maintaining that trust level.
Yeah, no, it's a beautiful, beautiful analogy. You said jar full of trust, and then you kind of started earning that. So, final question here, guys. It's a super great conversation. A little bit about AI, right? I know we're living in the age of AI, if you will. You guys are dealing with it from a tech basis, and you may be representing a lot of the key players here, Scott. So I don't want to make it hard for you to respond here. So, how do you think it'll impact your industry, the world in general?
I'll start really briefly. Like I think it's already creating efficiencies for us. I mean, just even with various software packages to help with diligence, to help with document preparation, to help even with research. I think the way I look at it is, and the way I've talked to our team is, for us, it's sort of like a junior associate that is very earnest and is really, really smart and really, really good, but they're still a junior associate. And so you just really need to verify. And it's from my perspective, it's great at doing the first draft of things. It's great at making the first pass through things. And that's really in anything, not even outside legal. But at least now, and at least as it relates to deals, I think it can create tons of efficiencies, but you still have to verify. And but I think it's going to be a very helpful tool to make lives of all of us a lot easier in transactions. We need to learn how to use it the right way.
No, you're right on that. So what about junior associates though? I mean, just curious because entry level jobs. How do you guys deal with it? How should the world look at it from that perspective? Then?
I just think, from my perspective, it's going to make their jobs easier, and I just think that whether it's accounting, lawyer, it should allow you to do more without working more hours. And I think there's going to be two types of people. There's going to be the folks that rely on it as the truth, and are maybe I'll use the word lazy and just say, here's the answer. And then there's going to be people that use it and then look at it and build from it, and they're going to be the ones that are successful. But the things that it can do right now, across the board, even like my clients that are trying to do pitch decks, it's some of the software that can put pitch decks together or business plans or things like that. The ability to get to that first draft in a half an hour instead of 2 weeks, that's huge.
Yeah.
I mean, that's really what I think. It's the first draft that I think, and whether it's legal, business, accounting, the ability to get the first draft done and minutes instead of days is the biggest thing that's I've seen.
It's actually really super well put, because does the first draft, and then you still have to apply the knowledge you've earned in school, work, and whatnot to refine on it. I'll tell you what, I've had an interesting experience with that. Last December, we went on a trip to New Zealand, the family and I, and I did a planning on one of the AI softwares. But what I missed was we rented an RV in New Zealand, and it didn't necessarily give me the extra time it would take to drive an RV. And we drove the entire both islands, New Zealand. Right, it became painful for me, because it was like, at some point, like, man, ChatGPT told me it'll take 4 hours. It's actually taking 7 hours, right? So I didn't necessarily take into account. Lesson learned. Stephen, from your standpoint.
Yeah. So in a deal-making standpoint, we see AI being a great tool to get through a lot of contracts. We have a client right now who has 700 clients, right? And it's not clear contract. There's some order forms, there's some purchase orders, there's some master service agreements. It's just kind of a mix of different contracts. And so we want to go through there quickly and figure out, are there approvals required for change of control? Are there approvals required for contract assignments? And so there's things like that where AI can be very helpful to get through just a great volume of documents and look for those key paragraphs and pull them out. So that's part of it. With respect to doing valuation work, so in our business of downloading publicly traded comps and doing valuation work, it helps to accelerate that. You can use that when it's a loose requirement. If you're doing a fairness opinion, you wouldn't rely on it, right? And so it just kind of depends on what your purpose of that is. So that's helpful there for sure. In terms of creating pitch decks, we haven't personally gotten leverage out of it. And one of the reasons why is the hallmark of Navidar is telling an investment story, which is often very different than the customer story. So our clients are used to really a pretty radical retelling of their story. None of it's on their website or in their marketing materials. It's all brand new. Once we do that, though, then AI can be helpful to come up with graphics or some buzzwords for us. Once we get that framework created and kind of pointed in the right direction, but it can't do things from scratch for us. I mean, if we give current website information, sure, it could do that, but we're typically not using that. So for us, it's a little bit of a hybrid use. And then certainly in marketing and outreach, there's applications there of how it can automate, email outreach and telephone calls and stuff like that, where it's interesting.
Okay.
Well, one thing I want to add real quick is just on the flip side of this, and another reason that I hire someone like Steven earlier than you would think, is that the private equity funds have these applications now that are helping them find companies in ways that they couldn't find them before, that are potential platform tuck-ins, all of that. And as a result, they're cold outreaching to these companies that might not even be thinking about a process.
Yeah. I did that.
The AI is helping them find it.
When I was running Think Power, I used a website. I think it's clay.com, if I remember right. And I actually, it actually, you can put in the company, information and say, hey, find similar companies.
Yeah.
And it'll kind of mimic. And it's not bad. I mean, if it gave me 100, 5 of them are all right, which is all right.
It's even better now. And so I think companies are going to get more inbounds than they ever have. Now, a lot of those inbounds aren't going to be worth pursuing, but you just never know when you're going to get that one that, oh man, I really need to think about this. And having, a banker, at your side ready for that is important.
Yeah. Stephen, has anybody changed the website after you came into the process and told them this is how you push in the company?
Yes, our favorite clients always do that.
I did,
including
honestly,
you.
it was great.
Yes, and so often we're having clients modify websites. I don't want to scare anybody that has to be a whole website rewrite, but we often do have people modifying some language or modifying the opening.
Positioning the company better, right? At the end of the
just
day.
to position the companies better. Mm-hmm.
Awesome. Hey, Scott, Stephen, seriously, I mean, I know it's a little over time. Deeply, deeply appreciate the words of wisdom you've shared. And I know from my personal experience, it is phenomenal experience working with both of you, Latham and Watkins, and obviously Navidar. super thankful to have you guys on the team. Hopefully we'll do one more deal together. And thank you for helping all the entrepreneurs who may be listening to the show. And, maybe we'll do one more down the road. Thank you so much for joining the show, my friends.
Thank you.
Take care. Thank you.
Appreciate it. Have a great day, everybody.
Bye. Yeah. Bye.
Bye.
Coming up next on From Boots to Boardroom,
we talk to people all the time about it. Success in life is not about what happens to you. It's about how you respond to what happens to you. 90% of your success in life is how we respond. And we got to respond the right way. The whole E plus R equals O. Tim Kite, and I'm a huge proponent of that.
in the next episode of From Boots to Boardroom, we sit with Brian Irwin, a leader who spent 20 years as a Texas high school head football coach before transitioning into the world of industrial safety. Currently the corporate health and safety officer for Bobcat Power, Brian has guided his organization to multiple American Electric Power's Contractor Safety Awards, most recently in 2025. Drawing on his championship-winning coaching career, Brian shares how he uses principles like loyalty and servant leadership to train and motivate his workforce, demonstrating how a coach's mindset can transform workplace culture and drive elite safety performance. Stay tuned for part 1,